So now it's time for, I would say, one of the most iconic chart patterns, and that is the head and shoulders pattern. The head and shoulders pattern is a bearish reversal pattern. So before the pattern, we have an uptrend, and after the pattern, we have a downtrend. The pattern itself consists of 5 important points. First of all, we have the left shoulder, which is this point right here. We have the head, and we have the right shoulder. The other 2 important points are these 2 low points that happens between the 3 high points. Or we actually have a 6th important point as well, and that is this point right here. And later on, I will talk about why that point is so important. And the reason this is called a head and shoulders pattern is because, as you can see, the pattern kind of looks like the head, the highest point in the head, and then we have the left shoulder and the right shoulder. And the pattern doesn't have to be straight like this. It can sometimes slope a bit to the right, slope a bit to the left. But the important point here is that we have a high, then we have a higher high, and then we have a lower high. What you also want to do for the head and shoulders pattern is that you want to connect the 2 low points in between the highs. So we want to draw a line in between this point and this point. And another tip for you guys is that this pattern becomes stronger if this low point right here is actually lower than this low point right here. And this is from a market structure perspective. After watching this course, I highly recommend that you guys check out my course on market structure. I will make sure to leave the link to that video up in the corner of this video. And the reason for this is that if this point right here is lower compared to the previous low, then you can see that we have both lower lows and at the same time we have lower highs. So in this case, after this high right here, we actually have the beginning of a downtrend, because in order to have a downtrend, we need to have lower highs and lower lows. That is the beginning of a downtrend. So having this point a little bit lower than the previous point makes this pattern a little bit more likely to succeed. So now let's take a look at the head and shoulders strategy and take a look at a real market example. So the first thing we of course need to do is to identify the pattern. In this case, you can see that we have one high, then we have a higher high, and then we have a lower high. And what you also can see here is that the lows in between the highs are sloping downwards. And as I said, that makes the pattern stronger. As for the entry points, we have 2 main ways to enter. The first entry point is this point right here. You can see when the price breaks below the downward sloping line. By the way, this line right here is what we call the neckline. If you use this entry point, the most common place to set your stop loss is to set it just above the right shoulder of the pattern. So you set it just above this point right here. And if you're using a 2-to-1 risk reward, your profit target would be all the way down here. So it is important to notice here that compared to the previous patterns we have been talking about, the head and shoulders pattern is a very large pattern. So it will take a long time to play out and you will need patience trading head and shoulders. Another way to take targets for this pattern is to measure from the head down to the neckline. And then you take this exact measurement and measure from the breakout. The benefit using this approach is that your target level can many times be a bit tighter, but depending on how the pattern look like, sometimes when we do this kind of measured move, the target level will actually be further away compared to a 2-to-1 risk to reward. So this will depend on a case-by-case basis. Another common entry is to wait for the neckline to flip to become resistance and then enter at a reaction from the resistance. This entry point is often more suitable for short-term traders because you will be able to have a much tighter stop loss, and because you have a tighter stop loss, you will be able to have a tighter target as well. So in this particular example, you could enter here at the reaction from the resistance. So you can see we're looking at this reaction right here. We have 2 candles strongly reacting from the resistance. Using this entry point, I would set my stop loss above the highest point of the reaction. So as you can see, I would set my stop loss above this candlestick wick right here. And because the head and shoulders is such a large pattern, What I like to do here is to leave a little bit of wiggle room. Sometimes you can actually, let me change color here. You can actually set the stop loss even higher here to allow for the price some more room to move here. But as you can notice, when we have a tighter stop loss, we will also be able to use a tighter target. So using this type of entry, your target level could have been somewhere around here if you're using a 2-to-1 risk to reward. And as you can see, this would make the pattern play out much faster. This video was just a very short clip from our full chart patterns trading course. So if you have the time, I highly recommend it to click or tap on the screen right here to watch the full video. I hope to see you guys very soon, but for now, take care. Ciao, ciao.